Good evening, friends. Request people to take their seats, please. We'll start in about 1 odd minute. So, good evening once again, friends. Warm welcome to Motilal Oswal Tower. As you would be aware, this forum is our flagship event, Value Investing Forum 5th edition. And this event is basically all about discussing aspects and insights on value investing by some of the biggest market mindsets. With every edition, we have been trying to bring newness and interactivity to the event, be it through content or through the panelists. Last year, we raised the bar on interactivity by getting leading financial advisors to interact with Raamdeo Agrawal on a panel. This year, we've raised the bar. So this year, for the first time, this event is being live telecasted to about 6 locations apart from Mumbai. So Bangalore, Delhi, Calcutta, Ahmedabad, Pune, Chennai, all these locations are watching live, and to my guess, about 1,000 distributors from MF fraternity are watching this event right now live. To set the tone for the evening, I would like to invite Mr. Motilal Oswal, our founder and chairman, Motilal Oswal Financial Services, to share his thoughts on this forum. Sir, if you could come. Once again, I welcome all of you to Value Investing Forum 5th edition, and hope you have a great evening. Thank you.
A very good evening to you, friends. It's really a pleasure for me to welcome you all, and especially many of our investors from 6 cities apart from Mumbai. This is the first time when we are, I would say, live from Mumbai across the country. So friends, this is the 5th edition of our Value Investing Forum. A very interesting one, although we have been practicing value investing as style for more than 15 years now. But the forum is just 5 years old, and this is the forum for us to share a lot of ideas and knowledge through this forum. Today's this learning session is going to be very interesting. It's in 2 parts. I think in part 1, Raamdeo is going to share his learnings from his 19 studies and his frameworks on investing through QGLP. And then in second part, we have got, I would say, a very learned panel of market practitioners, Sanjay Bhattacharya, Durgesh Bhai, and of course, Raamdeo Agrawal and Naveen Agrawal will coordinate, or he will try to manage the panel. If you look at, I would say, both the sessions, I would say there's a very strong correlation between the study on wealth creation and the part of the topic for the panel is learning from the Warren Buffett letters. I think many of our wealth creation studies came out of from various themes coming out of the Warren Buffett letters. I think some of them you must have gone through, whether it is great, good, and gruesome, or blue chip investing, or maybe winning categories, category winners. So I think many of the studies came out of some of the themes coming out of Warren Buffett. So in that sense, while I think doing the studies for many years, it has been great learning for us. And those learnings has been, I would say, reflected into the practice through whatever money we manage for our customers and what advice we give it to our customers. So thanks to those learnings and then application of that we have been able to, I would say, quite successfully manage the money since last 2000, I think last 13 years from 2003 when we started our PMS, formal PMS, although before that we were advising to the brokerage and I would say advisory services. But the PMS, the value, the names as value investing or the value PMS in 2003, I think that is become one of the largest PMS in the market. Both the value and the $1 trillion which we launched in 2007, we manage about 3,500 crores worth of money. And since after that, we launched our own kind of mutual funds. I think same philosophy, same framework continues. And in last about 1 year, we would be managing about 2,500 crores worth of money through our mutual funds. So in all, we manage about little more than 6,000 crores worth of equities, which puts us, I would say, in top 15 AMCs if we put across both PMS and AMC. I think, with your support, I would say our aspirations are very high, and we definitely want to become much more kind of, I think, bigger, but more importantly, the different asset management company. So friends, I think the first is the learnings, and second thing is that application, as we call it, the proof of the pudding is in eating. And through, I think, managing this money, we have been eating our own kind of, I think, philosophies of value investing, and more importantly, the title as QGLP, that is quality, growth, longevity, and price, which the Raamdeo is going to talk more in detail. And second thing is that we put our own money, or what we call it, we put our own money where our mouth is. And apart from what I would say net worth we have in our own company, Motilal Oswal Financial Services, most of our own money is also put into our own AMC schemes, which is Focus 25, 30, and 35. I think the performance has been staggering. Some of the numbers, if I would like to share with you of the PMS, I think since last, I would say 2003, the 1 crore invested in PMS has become about 19 crores compared to the benchmark, which is about 8 crores. But if I look at the recent performance in last 1 year, the value has given about 55% compared to the Sensex, the Nifty, which is about 26%. The last 3 years, while the Nifty has given about 17%, the PMS, the value has given 27%. But even the better performances in our TDOP scheme, which we launched actually in 2007, which is into mid-cap, benchmarked with mid-cap. And the benchmark, since inception from 2007, the benchmark has given only 6% return, while the scheme TDOP has given about 20% CAGR return in last, I would say, from 2007, so about 8 years. Last 1 year even has been very staggering. The TDOP performance is about 72% compared to 51% of the benchmark. So the 1 crore invested in TDOP has become about 3.8 crores versus 1.5 crores in the benchmark. And the same performance continued also. The mutual fund schemes, it's just about a year performance in all 3 schemes which we manage, which is large cap, Focus 25, mid cap, which is Focus 30, and multi cap, which is 35. I think the performance is absolutely stunning compared to the benchmark. Focus 25 has returned about 46% compared to 26%. Focus 30, I would say the highest, because say mid cap, it is 81% compared to the 51% in the benchmark. And multi cap, which is 71% compared to 32% of the benchmark. So I think I would say it's a great performance, and I'm very proud to share this kind of performance. And I'm very, very thankful to all of you, all of our distributors, all of our customers for showing that kind of faith in us and supporting us at all the time. And with that, I once again welcome you all. I welcome especially our panelists, and I would say hand over the mic for the next proceedings. Thank you very much.
Thank you, sir, for sharing a lot of interesting data on the performance. I just want to add one more data point. Last value investing forum we had in August 2014. And our total assets under management at that point of time was somewhere around 2,500 crores. As on date, we are managing about 5,800 crores. So I would say that the last value investing forum, which was the 4th edition, was very lucky for us. And thanks to all of you for all the support you have been giving continuously and consistently. Now the next session is the most sought out session, and for which I would like to invite Mr. Raamdeo Agrawal. and I would like him to share his story in his own words about his wealth creation journey and the various mantras he has learned along the way. So, sir, I welcome you. Mr. Agrawal, of course, doesn't need any introduction, but he is joint managing director and co-founder of Motilal Oswal Financial Services. We are also proud to have him as chairman of our asset management company. He's keen believer and practitioner of QGLP philosophy, and his wealth creation insights and decades-rich experience have played pivotal role in MOFSL, transforming it from small stockbroking firm to a well-diversified financial services company. His firm belief in value investing forms the core Motilal Oswal's investment philosophy. So friends, please join me in welcoming Mr. Raamdeo Agrawal once again. Thank you.
Hello. Yeah. So, good evening, friends, and warm welcome to Motilal Oswal Tower. It's always pleasure to stand here and talk to all of you. So it's here another opportunity. So this time, it's been a very different kind of format, very unusual. In fact, it's a kind of experiment that we have called you to talk about something Buffett letters. I mean, that has been one of the, for me, it is like Gita or Ramayana, and I've learned everything about investing. Apart from my CA degree, I think bulk of the frameworks or understanding has come from Buffett letters. So, we said this is the 50th year of Buffett letters, and even in Omaha, it is going to be a big gathering. I think it will be more like 50,000-60,000 people going there. I'm very clear that the hall will be so much full out there that we are going with 30-40 people from here. So it is going to be a big show out there, and we'll see. I mean, he has written very special letter. Even Charlie Munger has written, and they have tried to even predict what to expect in terms of next 50 years of Berkshire Hathaway and things like that. And if you know, Mr. Buffett started Berkshire Hathaway, and his biggest mistake was purchase of Berkshire itself, because as a business, the textile business was closing down. And I think that itself laid the foundation for his learning. So I think he has been very prolific. And as far as my own journey in stock market is concerned, it has been like a lot of bumps, and it has been a matter of luck that I'm here or we are here to see how it has evolved. But when I look back, because what happens is that in stock market, there are 10 million guys, there are 10 million ways of making money. So you have to find your way, and nobody is right, nobody is wrong. So I have to find my way, and there is no, in a classroom you cannot find your way of investing. And hence, you have to keep committing mistakes, and it's a long, torturous journey of finding your own way. So what happened was, in 1980, I bought my first stock, and when I actually entered the market in 85, 86, it was a very primitive market. When I look back, it was absolutely primitive market. It was a physical market. You had companies were very small. I mean, you're talking about single-digit numbers. The IPOs will be 2 crores, 3 crores, 10 crores. I mean, convertible bond issue of telco would be 10 crores, and it will flop, and there will be so much of headline news for that issue to flop. Cipla was about 5 crores total market cap in 87. In 1988, you could buy ITC, total ITC for 100 crores. So, I mean, just the scale. I mean, I was today talking to Mr. Parekh, and he said in 1978, total issue of HDFC was formed with 10 crores capital, 3 crores public issue, and it flopped. I mean, there was nobody to buy 30% of HDFC for 3 crores, in 1978. So it was a different world altogether. We were all there. I was chartered accountant by 83. So it was a very different thing. I mean, today this 3, 4 crores, 5 crores, they look to be like people pay for even one trip, this kind of thing. And marriages are today happening for this much amount, for that amount you could buy an entire corporation. So it was very primitive market, physical settlements. Settlements used to be officially T plus 15, but typically it used to happen T plus 21 or T plus 28 also. And all the papers were lying in the office. You were scared when you closed the office, whether tomorrow morning you will be safe or unsafe. Because hundreds of crores worth of shares of clients were lying, and you go out, put one lock and leave in the hands of few clerks. Next day morning, if there is a fire, even the offices were so bad. If there is a fire, there was no way to get the money back. So I think it was a very, very primitive market if you look back. That was the Dalal Street, the way it is shown, but the real iconic thing was the tower. And so that's how we kind of evolved in this thing. And the only thing we knew was EPS and PE. This was the total understanding of the stock market. And even growth word was not understood. So change in EPS, change in PE, and you are done. That's the only mathematics we knew. Probably calculators were not in hand. Computers, I think lack of computers. Computing power was one of the constraints, not only at a analyst level, but even at an investor level. Because how do you do the calculation? How do you do compounding? How to look at 5 years number? So it was physically impossible. So actually you could read the balance sheet and go and buy in the market, and you are far ahead of the entire crowd. So that was the that primitive was the market. And so we started very small in 87, and immediately after I started, I got married. I met Moti just a year before, and at that point of time, the biggest ignorance was your own ignorance. Just living in not knowing anything. It was just like we didn't know what is America, what happens there. There are so many journals are there, so many books are there, and the world had moved on, and we were there only. So the good thing was we were not knowing what is happening in the world. We were thinking what we know, we're the smartest guys in the town. But that sheer confidence and passion for equities, that kept us going because we didn't have money. We just wanted to make money somehow. And good thing was that I didn't get into the speculation. So that didn't throw me out from the market. So I survived in the market, and then the big thing happened. That was the first big thing for Motilal Oswal and for me was the Harsha Mehta bull run, 91, 92. It was, I don't know how many guys were there at that point of time in the market. We were doing business. We had bought the membership in 1990, and we had just about 10, 12 lakhs rupees. We borrowed 12 lakhs rupees. We bought the membership, and then that changed the entire game. And the bull run came. By the end of 1992, at the peak of the bull run, we had 30 crores worth of shares in our hand. A guy who didn't have 10 lakhs had 30 crores worth of shares, and then we said, boss, now nobody can throw us out from the market. So that was and then again the same thing happened. We bought the bank shares, and the scam happened in banks only. So, from 30 crores we came down to, so every time I used to go 10x and come down 3x. So the next was, the crash happened, but we didn't realize that what is a bull market, bear market. We said that was an accident, it happened, and we kept, there was no index, there was no channel, there was nobody NASDAQ, no CNBC, nothing. So you were happy, doing things. But by that time, books started flowing. Books, magazines, newspaper, all those things started coming in. And we started reading that because we were hungry for the reading, and we were reading only balance sheets till then. Now you're reading the books, and the very rapid globalization started happening. You started hearing about what is Morgan Stanley, what is Jardine Fleming, what is, so those times there was Jardine Fleming, and there were a few other global names. First time I heard this thing called Merrill Lynch. So they were giants at that point of time, but we never heard about them. So clearly, India was just about emerging in 93, 94, and thanks to globalization, we heard first time about Warren Buffett. Somebody, dear friend Sanjay, who's here, who is going to be part of panel. I think big clap for Sanjay introducing me Warren Buffett. So he volunteered to, he said, typically we always keep talking, so he said, why don't you read this? So I read this, and it was love at first sight. I read the letters, that 94 letter where he's talked about importance of return on equity. He said, don't focus on EPS, bother about return on equity, because he wanted us to, because he himself had committed mistake in the buying bad companies to start with, and then he was buying good companies by that time. So so that actually said, then I realized that, boss, this guy knows something. And then I read full 20 years, 65 till 95, and very next year, I could go to Warren Buffett show, that AGM, and you see the photograph. Actually, I was there with him, And just on the eve, you could, because it was such a small gathering at that point of time, very few were going. I mean, to travel 32 hours from here to Omaha, you go from here to New York to Chicago to Buffalo. So, Omaha. So it used to take a lot of effort to go there. 2,000-3,000 people used to be there. He used to be coming, talking to you, mixing around with you, have a photo shoot. He will sign the dollar bill, a book or whatever. So he's signing a dollar bill for me in the evening, and people used to line up and we used to get it signed. And so it was very easy, very small. He himself was not that rich. Maybe it was $100 billion or something like that. Was it? No. It was not that big. It must be, he was already a billionaire, maybe $10-15 billion by that time. So clearly, that was a wonderful site in Omaha, and we were just, we couldn't get enough of Buffett. So that was the starting. He was the bridge between, I mean, that ROE, return on equity, was a bridge between book value and intrinsic value. And Sanjay turned out to be a bridge between me and Buffett, so to say, you know. So that was the starting of building up of my investment philosophy from that primitive balance sheet reading and P and EPS kind of situation. Then on the way, then we started getting books. So one of the book which really also helped was, I would say, Common Stocks, Uncommon Profits, Phil Fisher, all-time classic, written 1958. Amazing book, amazing book. I think it's a must read if you can pick up. Then I think equivalent to Buffett for me is a competitive strategy by Michael Porter. I mean, how do you analyze competition? So this was another big book. Then, I mean, Buffett letters are there. Then you have another book by Value Migration by Adrian Slowetsky. Value Investing, later on explained by Professor Greenwald and Michael Mauboussin. So these are all books which has impacted deeply on the journey to our, what do you call, evolution of framework for investing. So in 1996, we started doing this wealth creation study. That was the first year of corporatization of Motilal Oswal. You know, I mean, we were a proprietorship company till about 1996. We started in 87, and Moti was the only proprietor this thing, and I was consultant to the firm. And then we formalized the thing in 1996, and to celebrate that particular occasion, we started writing wealth creation study. And then later on, we started doing every year. So the whole purpose was, if you go to page 3 or 4 of this book, he has said, if you enter any country, any market, first you understand how money is made in that particular market, because every market has its own uniqueness. So you must understand how exactly money is made. So we said, let's study the 5-year rolling, how the money is made, and the characteristics of it. Because just because in last 5 years what is happening, we want to make money in next 5 years, shouldn't be very different. So with that thought process, we started studying last 5 years companies which have made money and what are the characteristics of that. So that's how the whole wealth creation study started. Then came this book, Professor Greenwald, Columbia professor. He has visited India, and he is one of the best professors today of value investing. He's still teaching in Columbia. He has this summer programs. I think it is the best program for MBAs also in Columbia, and he does this seminar. So in fact, he called me once to do India Forum, and we went there just to say thanks to him for writing this book. And there he has talked about in this book 3 pillars of valuation: the breakup value, franchise value, and growth value. So that clears, I mean, this is only Buffett's thought process which he has put it very nicely. So there we learned one thing, that the same franchise profit, the growth is good only if it happens in the same franchise or in the same business. So that's why the Page industry or a Coke or an Asian Paint or a very focused companies, those who are just building up. And India is one country where all these companies are still very small. So, I mean, like an Asian Paint with 60% market share, they're selling just about just simple paint. But, I mean, they're gaining market share. A Colgate, I mean, they're just selling toothpaste. And there's so much more toothpaste to be sold. There's so much more paints to be sold. So every single, I mean, amount of growth, which happens 10, 15, 20% year after year, they are more profitable than last 10 years. So valuations, of course, are very important in this thing, but understanding the intrinsic value of a business you must, I mean, there is a difference between a growth in the same category and growth in a diversified new line of business. So this book is very, very clear and it's mathematical. I mean, Buffett gave framework, I mean, he talked stories and stories, but this guy, he crunched everything and gave a mathematical formula for people like us to understand more, in numbers, how do you look at it. So this is huge book. I think it is still recommended to be read by people. Then by turn of the century, we were at 12, 13%, 14% kind of a situation, 15% non-convertible bonds were order of the day. And then something happened post Y2K, and Indian interest rates collapsed from 11, 12% to more like 4, 5%. I don't know how many people remember, but that was one of the biggest slide in the interest rates here. And he wrote a letter, I mean, a page in Fortune magazine, which was impact of interest rate on valuation of assets. And that was, so he said, at all times, in all markets, in all parts of the world, the tiniest change in the interest rate changes the value of every single financial asset. So what happens is the value, what value you see is, there is no absolute value. There is no concept of absolute value. And values are all relative. So if you read this article, you can go and Google and figure out Buffett on market is one of the best articles ever written, 64, 82 and 2000. So all the bull run of 82 to 2000 in US has what really built the empire for Buffett in that period. So the importance of interest rate was very, very clear. Then while we were doing our 6th, 7th, 8th studies, then we came across this thought process. Let's understand what is the bargaining power. I mean, this Michael Porter thing, between consumer and the supplier. What kind of terms of trade you have? The companies which have very favorable terms of trade with the customer, vis-a-vis supplier. If you have a very favorable terms of trade, both sides, I mean, those kind of companies, they make a lot of money. So we have done this study. So, every time you are learning one thing in one study. So we understood the importance of what are the terms of trade in wealth creation. Then I think one of the best studies so far, I mean, looking back, and this is the most defining study which has impacted our investment style and the amount of money which we have made, is India, the next $1 trillion opportunity. That was in 2007. India hit 45 lakh crores GDP and rupee fell from 49 to 42. So suddenly, by default or by act of God, India became a $1 trillion GDP economy. That was in 2007. We said, let's understand this phenomenon, and we have become the top 12 countries in the world to enter the $1 trillion club. China incidentally entered that club in 1998. And by that time, we had seen what China had become. In 1998, we didn't know where China is. By 2008, all over it was China. So we said, is it the possibility for India that in next 10 years, it will be all over India? So this is what exactly is the study all about. And the main part of the study is that discretionary spend, where the corporate structure comes in, is going to just explode. I mean, what will be a linear GDP growth will be exponential business opportunity in the discretionary spend. And that's why we bought Page, we bought iShare, we bought a whole lot of these companies. And incidentally, in December 2007, we launched a small PMS called the Next $1 Trillion Opportunity. So it was launched right at the peak in 2007. And so that fund is supposed to buy all the stocks which will be positively impacted by the Next $1 trillion opportunity, which is discretionary spend in the economy. Then I think Buffett wrote the best piece in 2007 annual letter, page 16 and 17, where he wrote what kind of companies he wants to buy and what kind of companies he wants to avoid. Not buying, I mean avoiding. So great, good, gruesome. What is a good company, what is a bad company? I think this itself is sufficient to practice for any I would say, an outsider, if he comes to the market, and if he is able to understand this particular phenomenon, I think he has achieved 90% of investing good. I mean, how good investing he will learn only by reading this particular framework. So great, good, gruesome. I mean, it took 60 years or 50 years of investing for him to write this piece in 2007. So we were not that late in understanding this. So clearly, he wrote his insight in 2007 that there are only 3 types of businesses. good and great, better focus there, but 90% of the businesses are gruesome, useless businesses. And that's what is the source of trouble for all the investors, and it has to be avoided. That's why my first point in my investment philosophy is Q, non-negotiable, QGLP. First is Q, and that is 99% of the entire investment practice. So Q is non-negotiable. It is the non-Q or bad quality which brings all the misery to the investors. So this is a very transformative study and transformative piece of paper actually written by Buffett in his 2007 report in page 6 and 7. Then we did importance of dividends. I think another book, Buffettology by his daughter-in-law, she wrote that 3 books he keeps on his bedside. One of the book is 1938 classic Theory of Investment Value by John Burr Williams. And there he has talked about dividend discount model. And he has said there, a cow for her milk, a hen for her eggs, and a stock by heck for her dividends. So, this is the cornerstone of, you buy stocks for dividends. So, in this study, we have understood how important is the dividend for the companies and for the investors. Companies for the valuation and investors for their own prosperity. So, and it is going to take some time for the government, for the companies to understand what should be a rational dividend policy. Durgesh Bhai had been very, very helpful in taking us to, encourage us to keep talking about this to the companies and everybody, even to the authorities, SEBI and all. But it will take a lot of time for all these authorities to understand. Government has been raising, the only thing you get from the companies is the dividend. And there they're raising from the dividend distribution tax from 10 to 20% or maybe 21%, I don't know where they've taken. So I think government authorities are not understanding what is the importance of dividend, and they want Indian company guys to come into the market. And if you are making dividend very unattractive, how it is going to happen? So I think there is a huge importance of dividend in valuation of the companies and overall prosperity of the shareholder. We studied the economic mode, the ultimate of investing, where he talked about moats around the companies, and even Michael Porter talked about unique companies and what it requires to be, to reach in that kind of situation. So this was the study about uniqueness of the companies and how unique companies make money in the stock market. Then I think just 2-3 years back, again another framework which was from Michael Mauboussin, measuring the mode. And here I think after 30 years in the market, this particular study liberated me from the market completely. At that point of time, I realized that uncommon profits, abnormal profits in the companies is equal to abnormal profits in the markets. You don't have to worry about the market because markets are irrational, unpredictable. Whereas the profitability and quantum of profits to be made by the companies are far more predictable. I don't say it is perfectly predictable, but still you can have much better understanding. At least if you operate within a circle of competence, you definitely can have a better feel than your feel about the market. So this has actually reduced my focus on the market. Maybe it was 10% by that time to just about 1%. Then actually by that time, just 1.5-2 years back, we had already coined our mantra as quality, growth, longevity at reasonable price, because reasonable price was very important. Buffett said right in the beginning, have the purchase price so attractive that even a mediocre sale gives a wonderful result in the investing. So price was never in doubt. There is no investing without rational pricing of the companies. So clearly that the framework was there just about 1.5-2 years back, and then we did this study last year. This is 100x power of growth, because growth was not understood. And I checked all over. I wrote to Michael Mauboussin. I asked, of course, our biggest guru, Sanjay Bhattacharya. I asked him whether he has read anything significant about the growth. But actually, how to measure growth, how to find, how to predict growth, I think there are not many frameworks. And that's why we studied this, and we read about all the companies. I don't think our work is complete. It's a work in progress. I think we'll come out with some more papers on understanding growth. So eventually, the quality, growth, longevity of growth, and reasonable pricing at reasonable price. That has become the framework, but it's a journey which is on. It's a work in progress. Probably the name of the framework will remain same, But the what goes on into practicing that will become tighter. So QGLP is in action in value portfolio. Moti told this is the performance which we have seen in 12 years, and this is the performance in Focus 35 in last 11, 12 months. It is more than double. I mean, I'm really stunned, but probably it's a sheer stroke of luck that this style is in right now very popular. So it's a long journey. As it is said, it's time probably for somebody to retire. The woods, I mean, Robert Frost wrote, the woods are lovely, dark and deep, but I have promises to keep and miles to go before I sleep. Thank you very much. Join in the journey of QGLP.
Thank you, sir. Very mesmerizing story. I'll request Mr. Agrawal to stay back on stage for some time. Since Mr. Agrawal has been talking about all his wealth creation studies over the last 19 years, what better time than now and this forum to unveil a book which is compendium of all the 19 wealth creation studies done by Mr. Raamdeo Agrawal. And to unveil this compendium, the Art of Wealth Creation book, I would like to invite Mr. Durgesh Shah, Director, Corporate Database Private Limited, on the stage. Along with him, we would like to invite Mr. Sanjoy Bhattacharya, Founder, Partner, Fortuner Capital. Sir, if you could please come. We would also like Mr. Naveen Agarwal, Managing Director, Motilal Oswal Financial Services, to please join them, and Mr. Motilal Oswal himself. Thank you, sir. If you could join us. So friends, we'll be sending you a copy of this book over next few days. I would also like to share that the book is available on bookzone.in, and in some time it will be available on Amazon and Flipkart as well. So feel free to buy, and obviously we'll share one copies with you. Can we have some?
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.